Happy Friday, and welcome to our tax edition of the Calt Brief podcast. I'm Christine Tidgren, and I'm the director here at the Center for Agricultural Law and Taxation. And we're just going to review a few key issues that have come up over the last couple of weeks and hopefully get you up to speed. One of the things that you've probably seen is that on May 30th, IRS released a new draft version of the Form W-4. So you remember last summer, they released in June a draft version of a W-4 for 2019, and it was met with widespread disapproval. The draft at that time had requested some pretty personal information from employees that was going to be placed on the front of the W-4. There was a lot of concern about employee privacy. It also seemed like the calculations were complex. And so after receiving a lot of practitioner feedback, IRS went back to the drawing board and they decided for 2019 they would just essentially use the 2018 W-4. So the 2019 W-4 didn't really change. And they went back to the drawing board, and with this release, we finally have a restructured W-4 that's designed specifically to respond to the changes that were made by the Tax Cuts and Jobs Act. So, of course, we no longer have personal exemptions, which formed the baseline for the allowances, which has historically been how all of our calculations have been made. So this W-4 goes through and kind of has a 5-step process, and all employees aren't required to fill out all 5 steps. It's just basically depending upon your situation. But the form is designed to actually improve accuracy of the withholding. It's designed to not have as many personal questions regarding second jobs and things right there on the face of the form. And it's designed to give employees options. So kind of like last year, one of the key things is employees are really going to be encouraged to use that online calculator on the IRS website for the most accurate withholding. And so I think we're going to see more and more focus on people who are filling out their W-4, going online, making that calculation to hopefully get the most accurate calculation. But that form has been released. The IRS has requested that practitioners send out their comments by July 1st. And then they've said that they're hoping to get a more finalized draft rolled out by the end of July or so. That probably won't actually be the final form, but it will be a form that's close enough to final that payroll software companies can begin engineering the software that we're going to need to start the 2020 tax year using the W-4. So this new W-4 will only have to be filled out by those starting new jobs or changing their withholding in 2020. If employers want to use it for current employees, they can, but their employees can't be required to fill out a new form for 2020 once this is finalized and rolled out. So here's just a copy on, if you're looking at this on the screen, you can see a copy of the worksheets that have also come alongside this new form. The one worksheet in particular is designed to kind of figure out the best withholding options for those employees who have multiple jobs and also multiple jobs in their family. So again, I'd urge you to take a look, if you haven't, at the new draft form. Give your comments to IRS if you have some. They did listen to them last year, and those comments did result in their early draft form just being completely scrapped. So, so they do listen to practitioners, and so go ahead and take a look at what's out there. Also, the same day they rolled out the form, they did issue a FAQ, a whole series of frequently asked questions to sort of explain the thought process behind this new form. So again, I would draw your attention to that set of FAQs out there too, and it will give you further information on what IRS is looking to do with the new W-4. Also, just a couple days ago, I think it was yesterday, they released a draft version of publication 15T for employers. And so this is the set of worksheets to be used by employers when figuring out tax withholding for their employees. And so again, this is just draft. It's meant to correspond to the draft version of the W-4. And if you pull that up, you can see the pretty complicated worksheets that go alongside explaining how the calculation would be made for the employers. But again, none of this is final, but at least it shows that we're in process. We definitely will have a new W-4 come 2020. All right, a couple of other things that were released over the last couple of weeks. If you haven't seen them, we did get a new set of tables for depreciation deduction limits for passenger automobiles. So this is your light duty trucks and vans as well. And so it's nothing unexpected. If you don't take bonus depreciation, the first year deduction for passenger vehicles placed into service in 2019 goes up by $100, so it's $10,100. And if you take bonus depreciation, also goes up by $100, so you add that additional $8,000 for the bonus, and your first year deduction is $18,100. So there's a link on our website to the RevProc that they issued. It actually came out on May 21st. Another recent update that IRS put out was the new inflationary update for HSA limits. So that's available out there too. That's RevProc 2019-25. It was released on May 28th. And so again, we just see some inflationary adjustments for the maximum contributions that taxpayers can make to their HSA accounts. If you're single, that number goes up in 2020 to $3,550. And if you're married, that number increases to $7,100. So the minimum deductibles, the maximum out-of-pockets, those all increased. But those tables are available also on our website, and that gives you a link to the actual RevProc as well. Another announcement that IRS made this week that's important for you to know is that we are no longer going to have the tax transcript faxing service available after the end of this month. So if you remember last fall, IRS said it was going to be doing away with the fax service of tax transcripts to protect to protect taxpayer privacy. And it's kind of a red flag for identity theft and all of that. So now we are finally given the end date for the service. So the tax transcript faxing service is ending on June 28th. And after that, clients are going to have to make requests online, and we're not going to have any third-party mailing of tax returns or transcripts after June 30th. So beginning July 1st, 2019, you can no longer have a tax transcript mailed to a third-party address. So those are kind of important things to know. Now, clients can still request they have their transcripts mailed to them at their own address, but the only place where IRS will mail a tax transcript is to the actual address on file of the taxpayer. And there's an automatic phone service that you can call to have that transcript mailed. But if you are the tax return preparer, you cannot have IRS mail that tax transcript to your office, and you cannot have them fax it to you either after the end of this month. Now, if you need a tax transcript, you have a couple of options. You can have the client, you can call IRS and request that the client's transcript be mailed to the client's address of record. So then the client would just be responsible to bring it to you. Also, you can use e-services. Of course, you have to have the Form 2848 on file, but to obtain an unmasked transcript, you just call IRS to request that transcript be put in your e-services secure mailbox, or you can use the e-services transcript delivery system. So those are going to be the only options moving forward for receiving tax transcripts for your clients. So just keep that in mind. We also got a piece of informal guidance updated this last couple of weeks on the IRS website. If you remember back in April, IRS posted on its website a little paragraph explaining, it was intended to explain how the qualified business income deduction would impact farmers' uh, income averaging on Schedule J. But the paragraph was really awkwardly worded and it did not really communicate what was intended. So here's what the paragraph had said in April. It said, in figuring the amount of the qualified business income deduction, your income gains, losses, and deductions from farming should be taken into account, but only to the extent that that deduction is attributable to your farming and included in elected farm income. Well, that of course was worded to explain how to calculate the qualified business income deduction, but that's not what we were seeking to calculate, and that would not be the proper way to actually calculate the qualified business income deduction. So shortly after they posted this on the website in April, they did remove it, realizing that it was misleading. So a couple of weeks ago, IRS reposted a new paragraph that explains what they really intended in terms of how does the qualified business income deduction impact the calculation of income for purposes of income averaging. And so it says more what we expected it to say, where basically if you're electing to use Schedule J to calculate your income tax using income averaging, then you figure all the amounts that you have for income, and you take into account the QBI deduction, but only to the extent that that deduction is attributable to your farming or fishing business. So in other words, you go ahead and you reduce your income on the Schedule J by the amount of the qualified business income to the extent that that deduction is attributable to your farming business. So if you have QBI deduction from another trade or business, that's not going to impact your income on the Schedule J. So again, nothing earth-shattering in terms of what was provided. It just got it right this time because it basically says that your elected farm income is affected by your QBI, whereas the other paragraph had been worded to suggest that your QBI deduction was somehow impacted by the elected farm income. So that's out there. It's on the website. You can take a look at that as well. So one thing that we're watching closely, just because of the significance of the changes that would be made, is some pending legislation dealing with retirement accounts. This is a bill that passed the House on May 23rd overwhelmingly, 417 to 3. And this bill, it's called the Setting Every Community Up for Retirement Enhancement Act. It's called the Secure Act. It really would make the most significant changes to our retirement system that have been made for a very, very long time. So there's just a lot of changes that would be made by this bill. The House passed its version. The Senate has not passed the bill, and we'll talk in a minute about what's going on there. But let's just take a look at a few things that would change under this bill. So it would remove the upper age limit for IRA investing. So you could continue to invest in tax-free IRAs, um, until you die. It would also increase your RMD age from 70 and a half to 72, so you wouldn't have to start taking your required minimum distributions until you reach 72 years of age. It also would allow some penalty-free withdrawals for new babies and adoptions, and increase the credit for retirement plan startup costs. Also, small employers could more easily join multi-employer plans to be able to more effectively offer retirement plans for their employees. So the whole idea of all of these changes is to really enhance employees' abilities to save for retirement. There's a recognition that we're all getting older here in America. We're having record numbers of people reach retirement age, and we just need to do a better job of preparing our system to handle this. And so this bill is designed to allow for more effective means for encouraging savings amongst employees. There's another change that got put into this bill at the last minute, and that is they finally just decided to roll back the entire Tax Cuts and Jobs Act kiddie tax provision. So if you recall, the Tax Cuts and Jobs Act, what it's done for unearned income of children is required that it be taxed under the trust and estate rates, right? So it used to be taxed at parent rates. For ease and simplicity was the intent of the law. They decided to let's not require that the parent tax return be tied to the kid's tax return, so that the child can actually receive a refund and all those things separate and apart from the parent filling out their tax return. So if we're going to do that, let's just go ahead and then tie the kid's unearned income to trust and estate rates. The idea was that would be an easy way to be able to separate those two forms. Well, there's been a lot of unintended consequences that have rolled out from this change. And so one of the most publicized ones is called the Gold Star problem, right? So children of Gold Star families, a parent is killed in service, they receive military benefits. It has significantly increased their tax liability for those payments. Another unintended consequence, I think, of this law were certain scholarships that are paid that are not for tuition, but are for other expenses. They end up being taxable income and they're treated as unearned income to the students. And so it has really come to the forefront that some of these scholarships are now taxed at much higher rates than they were before as well. So these are just a couple of issues that have come up that got lawmakers concerned about the new kiddie tax provision. And they had looked at just sort of taking a scalpel to it and carving out a very narrow exception to this new provision for the military benefits, for example. But the House, in the end, what they decided the best option is to just completely repeal that new subsection that was put into the Tax Cuts and Jobs Act to require the kiddie tax rates to be in sync with the trust and estate tables. And so the House version just completely rolled it back. And so that all passed the House, like I said, completely overwhelmingly. There's a couple of things that are of concern to taxpayers and employers as well that are in this bill. And so it's just good to be aware that if this bill ultimately does pass through both houses and get signed by the president, there will be definitely some need for some new planning with respect to some clients. So one of the most significant changes that would make for higher tax liabilities for some clients would be when it comes to inherited IRAs. And so a new provision would significantly modify what we've called stretch IRAs, where if you're a beneficiary and you're 30 years old and you inherit an IRA from someone who passes away, then you get to spread out your required minimum distributions over your life expectancy, which for a 30-year-old, that's a pretty good number of years. And there's been some significant tax savings recognized because of that ability to do these stretch IRAs, for example. And a lot of planning has gone into kind of maximizing benefits by choosing whom to give certain IRAs and things like that. Well, the new bill, the new law, if passed, what it would do is it would give you a maximum 10-year period within which you have to completely withdraw the inherited IRA and, of course, pay taxes. So for younger beneficiaries, that 10-year period is significantly less than their life expectancy, and this would result in much larger tax bills for some beneficiaries. Now, if you're a child, if your parent dies and you haven't yet reached age 18, the 10-year clock starts after you reach the age of majority. So you get a little bit of additional time, but even so, this change would result in more accelerated and larger tax bills for those who inherit stretch IRAs essentially. Um, it would also mean that there would be probably some other alternatives to planning that would become important. And so we'll just sort of have to watch and see what happens, see if the Senate ends up passing this, see if they end up passing the same provision. The Senate bill that they've proposed actually had a 5-year period instead of a 10-year period. So that would really cut back on the tax savings that can be recognized with these IRAs. So again, something important to watch. The bill in the House that passed the House also puts into place some new protections for long-term part-time workers. So as we are moving, it seems like we have moved to a culture or a workplace culture where there's a lot of there's a lot of people taking shorter term jobs, maybe some more part-time workers, maybe some people taking part-time work on a long-term basis. And the Congress is concerned that some of these people fall through the cracks in terms of what benefits they're offered by their employers. And so one of the protections that would be put in place by the Secure Act is to say if you're a long-term part-timer, and that's defined as anybody who works 9.5 hours a week for at least 3 years. If you fall into that category, your employer is required to include you in any of their retirement plans that they offer. So you would be eligible, for example, to participate in the 401k that would also allow for the employer matching, etc. And so, there is some concern amongst those who are studying this to say, well, if employers are going to be required to provide these benefits to everybody, will that mean that they'll scale back on the benefits that they provide? And I don't know. I think it's definitely too early to tell. But the idea behind this protection is actually for the benefit of the workers, to make sure that these long-term part-timers have some ability for employer-provided retirement, just like somebody who's working on a more full-time basis. So where is this heading? Like I said, it just overwhelmingly passed the House. The Senate had its own very similar bill that it was looking to pass. It's called the Retirement Enhancement Savings Act. So instead of being called the Secure Act, the Senate version is called RESA. But what happened is once they saw that the House bill had such support, there was a push to hopefully just get automatic consent. And a lot of people were pushing, hey, senators, can you just give automatic consent to this? And let's just get this new law passed. But there was some pushback to that. In particular, Senator Cruz did not like the fact that the House bill did not include a provision that would expand Section 529 plans to cover homeschooling expenses. He's been really working to get that change made. He was very disappointed it did not get put into the original Tax Cuts and Jobs Act. And so he blocked the automatic consent. And so now we're looking at, will the Senate bring the House provision, the Secure Act, up for a vote? And it does look like they will try to pass the Secure Act. If they don't, then we'll be back to them trying to pass RISA, which even if they do pass it, then it would have to go through the whole reconciliation process and it would just be very stretched out. So this is kind of an important time to watch to see what's going to happen, because I think this thing will either go through pretty quickly or else it might just get tabled for a while. And it just might be one of those things that these are provisions that lots of lawmakers have been trying to get through for several years, and they sort of see an open window right now. And so we'll see if they get passed. But if they do, we'll have to really take a closer look at them, because again, there's a lot of little details in here that will be important for planning. It might mean that in some cases, Roth conversions are going to be more important to some of those clients who are no longer able to do the longer stretch IRAs. So again, we'll have further education on that if indeed that does pass, but we'll keep you posted on that. All right, so our farmers have really been having some tough times recently, as you all know. The prices have been down. We've had trade disputes with China, now recently with Mexico as well. And so just a lot of concern for them. And then many of our farmers have been hit with disasters this year. We've seen the flooding in the Midwest in particular, but then there's also been the wildfires and the hurricanes and everything else. So just a lot of stress on the farm economy. So back in May 23rd, Secretary Perdue made an announcement to say that the market facilitation program payments that were made in 2018, they were going to create another program in 2019. So we are going to have another MFP program in 2019, but we're pretty short on details. What the announcement said is that the program in 2019 would include $14.5 million in direct payments. So these are going to be direct payments to farmers. We weren't given the payment rates. We weren't given, how many cents per unit that we would get paid for each commodity, et cetera. Also, just don't know some things. The announcement said that if you did prevented planting, that your acres would not be eligible to receive any MFP payments in 2019. However, the announcement also said that the payments were not going to be based on your actual 2019 production, and they would be calculated using county data. So again, we're just giving generalities. We don't know exactly how this program will work, but we're watching it. There was some discussion earlier this week that Secretary Perdue sort of suggested, well, maybe prevented planting acres could be included, but then it seemed like it was told to some reporters later in the week by some high ranking officials in USDA that no, there's definitely no plan to allow prevented planting acres to be included in the MFP payments. So again, just a lot of questions. We need to watch this closely for our farm clients. What we were told is that there would be up to 3 separate installments. The first installment of payments would likely be made by the end of summer. So that would be fairly quick. Then a second round would be made at the end of this year. And then if a third round, if it's needed because of market conditions, that would be issued most likely at the beginning of 2020. So again, we're just watching to see where this goes. Now, this also kind of goes hand in hand with a new disaster aid package that was signed into law this week as well. So we just got the new disaster aid package signed by the president. It is $19.1 billion of aid to cover all sorts of natural disasters that have occurred in our country over the last 2 years. So this package is for 2018 and 2019 disasters. It includes just over $3 billion in direct farm disaster assistance. And so language was put in there to include compensation for stored grain and compensation for prevented planting. So we'll talk about that in a minute because we're not exactly sure what that means in terms of what compensation farmers are going to get for prevented planting. Part of what makes all of this policy very difficult is that it's being announced, as you know, while farmers are making some sort of last minute decisions about whether they're going to plant acres that have been hit hard with excessive rains or excessive flooding. And part of what the government does not want is farmers' decisions to be based upon a government payment program. So they're concerned to announce too much of the details of, I think, either the disaster aid payments or the MFP payments, with the thought that if we give them specific details, then people may base their planting decisions not on what's best for the particular market conditions and the weather, but based upon what would result in the highest government payment. So that has sort of been what has been announced from USDA in terms of why we're not seeing more details at this time. But one thing that we are told in the actual law itself is that crop insurance payments up to 90% of the loss are covered, and payments to producers not covered by insurance will be made up to 70% of the loss. Now, what's been confusing is the fact that the $3 billion in payments wrote in there aid for prevented planting, and then it doesn't explain how that applies to the 90% and the 70% of the loss. It is really not expected that people who do not plant would get 90% of their so-called loss, but it could be read to suggest that that's the case. So we're just waiting for further details. In the meantime, I would say no one should plan on that. We just don't know how these payments will be made, and so we just need to kind of realize that no one knows at this time how any of these programs are going to work because they're just short on details. We do just know that there is money allocated, however, for aid for losses that were incurred because of disasters. One non-disaster provision that was written into this disaster aid bill impacts those receiving market facilitation program payments. And so what this does is it removes the $900,000 adjusted gross income limit for MFP payments if more than 75% of your income is derived from farming. So the idea is that the MFP payments have been treated with the same income limitation, payment limitations as regular farm program payments. So they wrote those same limitations into the MFP guidelines. And so, you know, you can only have a payment of up to $125,000 under farm program payment, and that same payment limitation was put into the MFP language as well. Now, the $125,000 limit stays in effect, but where they adjusted the language was with respect to the AGI limit. So lawmakers decided that making the $900,000 limit apply to the MFP payments as well was hurting some farm entities in particular, because as you know, if you're an LLC, you have a $900,000 limit, regardless of how many individuals are owners who are actually active farmers. So that allows you, if 75% of your income is derived from farming, to still receive an MFP payment, even if your AGI is over 900,000. So that provision is there. It's important to realize it. One of the things that we have looked at over the last year, we've been getting a lot more questions on, is just the historical idea that you can defer your taxation of your crop insurance payments for 1 year. That's been in the code for a very long time. and we sort of take it for granted. A year like this, however, that has all these new payments coming up, right? MFP payments, new types of disaster payments that are treated like crop insurance, it just makes all of those provisions more important. So over the next couple of weeks, we'll be putting some more resources on our website, sort of detailing how all this disaster aid is taxed, detailing a refresher on how crop insurance deferral works. But just remember that MFP payments are not crop insurance. So a lot of people ask if there is a way to defer those payments, and the answer is no. If you're, most of our farmers are cash basis farmers. They received the payment in 2018. That was 2018 taxable income, and that's how they had to report it. Um, it turned out that the 2018 MFP payments were really important to farmers' bottom lines. Those payments comprised, I think, a much higher percentage of farm income than many people expected. And so it will probably be the same story in 2019 as well. So any MFP payments that your farmers receive are going to have to be taxed in 2019. So we do have a separate law for crop insurance, as you know, and then the regulations that implement the crop insurance apply the same rules to disaster payments that are treated as crop insurance payments. So with this new disaster law, the payments that will be made for the loss of crops will be paid out as crop insurance. And so those payments, if they are paid out in that manner, will also be subject to the same deferral guidance. And so, if eligible, cash basis farmers will be able to defer the taxation of those payments to 2020 if it was their typical practice that they would have sold a substantial portion of the grain for which the compensation is being made in 2020, right? So the provision that we're looking at in the tax law is section 451F. It used to have a different subsection letter, but it got renumbered because of some other changes in the law with respect to cash accounting. But the 451F election says if you're a cash basis farmer and under your usual practice, a substantial portion of your crop would have been sold in the following year, thereby not recognizing that income until 2020, then you can elect to defer the disaster payment that you receive or the crop insurance payment that you receive in 2019. You can elect to defer that recognition of income to 2020. Now, the only way that you get this deferral is if you've suffered actual loss because your crops were destroyed or damaged. And then the law also has the special provision in there that also applies to prevented planting payments. So if you're unable to plant your crops because of a natural disaster, it's treated as insurance proceeds and the same provisions apply. Again, this only applies to payments made because of losses, because of weather, because of natural disasters. If you get your payment for your crop insurance in 2020. So let's say you suffer your loss in 2019, but the crop insurance payment doesn't come to you in 2020. Just remember, you can't defer that to 2021. It's only deferrable if you receive the payment in the year of your loss, and then only if it's been your historic practice to sell a substantial portion, which probably means at least over 50% of your crop the following year. And you have to defer payments for all of your crops unless you have separate trades or businesses set up for them. So if your soybean business is separate from your corn business and you actually keep separate books and records and all of that, then you could make separate elections because you're actually filing separate returns. But if it's all part of the same trade or business, then you have to do the calculation and do the deferral for all of your crops. You can't just pick and choose. So that's just a little bit of a refresher. Again, we'll have some more information on our website soon that kind of walks through all of these requirements. Now, another question that comes up in this context is most of our farmers actually have their crop insurance under a plan that includes revenue protection as well. So it's sort of a combination revenue protection, crop insurance, but also covers losses due to natural disasters such as drought or flooding. And so the crop insurance deferral provision only applies to those payments that are made to compensate farmers for actual losses due to destruction or damage. It doesn't apply to um, payments that are made because the market price has dropped. So does that mean if you have a revenue protection policy that you don't get any of you don't have the ability to defer any portion of your payment? No, I mean, historically, farmers have deferred that portion allocated to the loss itself. So the destruction or damage because of the bad weather. Um, you don't get to defer the portion that's for a drop in market price. So what that requires, and IRS has never given us guidance on this, so this has just been tax professionals figuring out how to do this, but all that we have done historically is to use a reasonable allocation method to divide up the portion of the payment that's attributable to the natural disaster and any portion of the payment that was related to compensation for a lower market price. And so the portion attributable to the loss or destruction because of the natural disaster, you can defer, and the portion of payment attributable to just the loss of revenue, you cannot. So again, I think that at this point, it's just any reasonable method will work, and until we receive any additional guidance from IRS, that's historically how practitioners have reported this, and it's not that difficult to make that determination. And sometimes the insurance company will do the allocation for you so that when you receive your payment, you kind of see how it's broken up. All right, another piece of guidance that we have really been waiting for and thought we would have by now has to do with Section 199A and how it applies to agricultural and horticultural cooperatives and their patrons. So this is that wonderful 199 Cap A subsection G provision. We have the reduction for patrons who receive payments for selling grain to cooperatives. We also have had that transition rule that's been sort of difficult to apply, and we've been waiting for IRS guidance with respect to how are these provisions to be applied. Particularly, one of the biggest questions we've had has to do with different allocations um, when running through these calculations. And back in April, the OIRA, the internal review, began on the proposed regulations that were created by Treasury. And so they received those regulations for review on April 2nd, and then they completed their review May 17th. So they sent them back to Treasury. But as of today, June 7th, we still haven't received any proposed regulations. So we're watching. As soon as they come out, as soon as they're released, we will let you know, and we'll post that information on our website. Another update for those of you who do Iowa returns is the Iowa legislature did reinstate the geothermal heat pump tax credit this year. So it's retroactively reinstated for January 1st, 2019. And so just this week, the Iowa Department of Revenue issued some guidance in terms of what needs to happen if you want to take that heat pump tax credit for installations completed this year. And so before you can take the credit on your tax return, you actually have to apply for a certificate. So that application process is out there on the Iowa Department of Revenue's website. There are limited funds, so it's a first come, first served basis. So if you have clients that we're installing geothermal heat pumps this year, encourage them to get that information to you right away, because the sooner that you can fill out the application to get this 2% credit, the more likely it is that you will actually be entitled to the credit. There's $1 million available for this credit in 2019. And the department says in its guidance here that it will establish a wait list, but that it will service taxpayers on a first come, first served basis. So just if you have clients in that situation, I'd urge you to go check out that information on the Iowa Department of Revenue's website. Also, I wanted to tell you about our summer seminar that we're having in just over a month. It's coming up, and I'm very excited about it. We have a lot of speakers coming in to talk about issues related to our agricultural businesses. So we're going to take a look at pending tax issues, transition planning issues, just business planning issues. We're going to try to look at specifically what things do we need to be concerned about if we are making an S election, if we've been a C corporation, what are some red flags for converting from one entity to the other. It's just some tax considerations to think about if we're doing that. Also, we're going to take a look at some of those issues that have impacted taxpayers on 2018 returns. So we have a lot of returns, a lot of entity returns in particular, that are on extension. And so we're going to take a look at some of those issues that have caused the most heartburn for our practitioners, and kind of discuss some tips and ideas on how to deal with those. Also, if we do get those cooperative proposed regulations, we'll definitely be running through those and discussing those at this seminar. We're also going to talk about some disaster tax issues, some tax issues of how to report disaster payments. Also take a look at family farming corporations and entities and LLCs, and some best practices for transitioning the farm business, and some impacts of the financial distress that has been hitting the farming sector. So we're going to look at some tax considerations for financial distress, and take a look at some Chapter 12 bankruptcy issues, and just options that your clients might have when they're facing financial distress. So again, really excited about this seminar. It's going to be held at the Alumni Center this year, but it's also available online too. So you can sign in for this 2 days completely online. We're adding a video option that we will have the seminar webinar attendees. You'll be able to watch it as well with video. So we're excited about that. And signups available on our website. Again, that is July 18th and 19th, right here in Ames. So again, that's sort of a look at some of the important things that have been going on the last couple of weeks. And we look forward to giving you updates on the website as they come out. And thanks for tuning in, and we'll be in touch.